This Chapter 2 provides a brief overview of standardized documentation used for repos and reverse repos. Many repo transactions today are documented under a Global Master Repurchase Agreement published in 2011, although earlier versions of this document exist that still govern many transactions. Like the ISDA Master Agreement, the purpose of the GMRA is to establish the high-level provisions that govern the relationship between the two parties, and then leave for individual confirmations the task of laying out the specific features of each transaction, including in particular the key economic terms thereof. And like the ISDA Master Agreement, the 2011 GMRA is tedious and technical and will turn you to stone or possibly salt if you attempt to read it in full. Accordingly, we will limit our discussion to an overview of the GMRA's most important provisions and certain defined terms if they differ from our own. Starting with defined terms, we note that the GMRA uses the terms seller, buyer, and securities exactly as we have done, in addition to the terms purchase date, purchase price, repurchase date, and repurchase price, this latter meaning specifically an amount inclusive of repo interest. The repo interest rate, however, is referred to as the pricing rate, and the repo interest paid under the transaction is referred to as the price differential, which refers to the difference between the purchase price and the repurchase price. Avoidance of the word interest is intentional to increase the contractual indicia associated with sales rather than loans. We note in addition the following important definitions in the GMRA. Income, which refers to a payment of interest or principal on the underlying bond or dividend in the case of stock. This definition is used in Section 5, which stipulates that any payments of income received by the buyer while holding the purchased securities must be passed over to the seller. Note the inclusion of principal, so that if the buyer happens to own the purchased securities when an amortization of principal occurs, he does not get to reap a windfall from it. Margin ratio, which is the ratio of the fair value of the purchased securities divided by the purchase price, so 1.02 in our earlier example. Note that the GMRA does not use the word haircut, although many practitioners use this word in a manner more or less equivalent to our margin ratio. Margin securities, which refers to securities transferred in fulfillment of a margin top-up obligation and must be reasonably acceptable to the party entitled to this margin. Margin transfer, which refers to the payment of cash margin or the transfer of margin securities in whichever direction. Finally, transaction exposure, which essentially means the amount by which one party is exposed to the other party after taking into account any minimum margin requirement. Thus, if, for example, the dirty price of the underlying securities is 9.8 million at the moment in time, while the purchase price plus repo interest accrued thus far has reached 10 million, the transaction exposure at such time would be 400,000, assuming a 2% margin is required over and above the repurchase price. With the important definitions out of the way, we lay out next the working logic of the GMRA, which contains 11 key operative sections plus another 10 that contain standard boilerplate language. Section 1 states that the overall framework for what the agreement is intended to cover, namely a variety of sales and purchases of securities from the seller to the buyer. Section 2 contains the definitions. Section 3 explains how each transaction is initiated, what the related confirmation must specify, what each party must do on each of the purchase date and the repurchase date, and how open-end repos, which are repos that do not have a specified maturity date, can be terminated by either party. Section 4 contains the various provisions for the establishment of margin and its maintenance, including the different alternatives available to the two parties as discussed in Chapter 1. Section 5 addresses the buyer's obligation to pay over to the seller manufactured coupons or dividends and any receipt of principal. Section 6 contains relevant specifications for how cash payments and transfers of securities are implemented, in addition to a key provision specifying that if any withholding tax applies to a coupon or dividend payment, the manufactured coupon or dividend must be grossed up to equal the amount that would have been received if no withholding tax had applied. Section 7 contains important clarifications for how payments are converted into different currencies where this is relevant. Section 8 describes a mechanism that makes it possible for the two parties to agree to a substitution of certain securities for others previously sold and purchased. We mentioned these substitution rights in Chapter 1. Section 9 contains a series of representations and warranties made by each party to the other, including standard representations as to the due authorization and legality of each transaction, and also to establish that neither party has relied on the other in any way in deciding to enter into the transaction. Section 10 defines the events of default under the transaction, which include the failure to deliver cash or securities when required, whether for the initial exchange, the final exchange, any manufacturer coupon or dividend, or any margin transfer at any time. Also the bankruptcy of either party, the suspension of either party from membership in various organizations, or if any representation made by either party proves to be false in a material respect. Section 10 also describes the remedies available to the non-defaulting party, which are essentially to terminate all transactions and claim damages resulting from the first party's breach, if any. Section 11 contains a number of tax-related clauses, including an important one which stipulates that if either party becomes subject to a tax that was not contemplated initially, that party may request an early termination of the agreement, which the other party is obligated to consent to unless he is prepared to indemnify the first party against this tax. Finally, the remaining 10 sections contain mostly boilerplate, principally addressing the day count conventions for calculations of interest, the mechanics for delivering notices from one party to the other, the governing law of the master agreement, the submission by both parties to the jurisdiction of English courts, the waiver of any immunity that might otherwise apply, and the parties' agreement that telephone conversations between them may be recorded. Very importantly, the master agreement provides for netting across all transactions between the two parties, whether for purposes of margining or for closing out the outstanding transactions upon an event of default. This runs parallel to the ISDA master agreement and is subject to the same caveat, namely that even though netting is explicitly provided for in the agreement, it may be deemed unenforceable under the relevant national law if either party has filed for bankruptcy. Of course, if netting is unenforceable, the potential credit risk each party is assuming towards the other grows significantly if they come to have a large number of repos between them. If you need to review the implications of netting on counterparty risk, you should review our model on counterparty risk management. One final important issue is the matter of failed trades. It is not uncommon in the repo market for one party to fail to deliver securities on the date required, even in the absence of any doubts as to his solvency. The failure to deliver could simply be the result of administrative error, or may result from a failure by the counterparty on the other side of the trade to deliver those securities in the first place. It has been long debated whether such an event should constitute an event of default. The 2011 GMRA stipulates that it does, since a substantial number of its contributors felt that often enough a failure to deliver securities might represent early signs of a deteriorating financial condition. The GMRA therefore includes it among the events of default, but leaves it to the non-defaulting party to decide to waive the event of default if it is not worried about the viability of its counterparty. In such an instance, the non-defaulting party's obligation to deliver cash is suspended until the securities are duly delivered, and the non-defaulting party is entitled to recover damages resulting from the other party's failure. As a result of the suspension of the buyer's obligation to deliver the cash required, Party A will be paying accrued interest on this cash at the repo rate, even though he does not have use of the money during this period. This brings us to the end of this chapter 2.